Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Hey there, welcome to the show today. Thanks so much for stopping by. We've heard a lot from parents recently about the impact of inflation on their hard-earned college savings that they've been doing. So we thought we'd talk about that today. Let's get right to it. A survey of college savings finds that parents are increasingly concerned about the impact of inflation and stock market volatility on all of that college savings they've been doing. Fidelity's 2022 College Savings Indicator Study reports this. About 81% of parents are worried about the stock market, up from 74% just 2 years ago. At the same time, concern about the pandemic has increased from 71 to 62, or I should say decreased from 71% to 62%. So that's pretty significant. College remains the top savings priority of parents of college-bound children, and they are increasing the amount they save as college costs continue to increase. 76% of parents have started saving for college, up from 58% in 2007. But while parents hope to save 2/3 of their child's college costs, up from 65% in 2020, they are falling short of this goal. Parents are on track to save 27% of college costs, down from 33%, and this may cause a majority of parents relying on guesses about college costs instead of actual data. Almost 30% of parents with student loans have not yet started saving for their children's college education. 88% of parents with student loan debt plan on redirecting their student loan payments to college savings when they're done repaying their student loans. So that's good. Now let's talk about the impact of inflation on the stock market as a whole. So inflation rates appear to have peaked at 9.1% in June of 2022, but inflation rates are still elevated, 8.5% in July. Inflation rates haven't been this high since '82. The Federal Reserve Board has been increasing interest rates by a total of 2.25% since March 2022 to try to control inflation. Inflation is caused by a mismatch of supply and demand, most recently triggered by supply chain problems and, of course, the war in Ukraine and the pandemic. So increasing interest rates increases borrowing costs, affecting credit cards, auto loans, business loans, and mortgages. The Fed hopes that this will slow spending. But increasing interest rates is a blunt instrument that's not narrowly targeted at the root causes of inflation. The recent increases in inflation are a global phenomenon. Also, historical data actually shows at best a weak correlation between interest rates and inflation rates. Yet, increasing interest rates is the primary tool available to the Federal Reserve. When your only tool is a hammer, everything looks like a nail. Or, more aptly, when your only tool is a screwdriver, investors get screwed. Stock valuations depend in part on calculating the net present value of future revenue streams. So a higher discount rate, such as higher interest rates, yields a lower valuation. So stock market turmoil is likely to continue for as long as the Fed continues to tinker with their interest rates, probably for the next year or so. But interest rate moves by the Federal Reserve and the stock market's reaction are inherently hard to predict. So here are some practical tips for college savers. Investors should therefore just go ahead and stay the course and remain invested, continuing to invest every single month. According to the Fidelity study, 83% of parents are planning to increase or even maintain the amount they contribute to college savings plans this year. That's good. Pulling your investment now is only going to lock in your losses, causing you to miss out on the economic recovery. Liquidating a 529 plan may lead to a tax liability too. That's not good. Stock market volatility has less of an impact on families who chose an age-based or enrollment date asset allocation. Such dynamic investment glide paths adjust the mix of investments periodically, reducing the percentage invested in stocks as college approaches. More than 2/3 of 529 plans are invested in age-based or enrollment date investment options. These investment options bottom out at about 10 to 20% in stocks when the college enrollment is imminent or when the student is already enrolled in college. So this reduces the impact of a bear market or correction on college savings. During any 17-year period, there is at least one bear market and at least 3 corrections. But investors can still use student loans to delay taking a distribution from their 529 plans. Qualified distributions from 529 plans can be used to repay up to $10,000 each in student loans for the beneficiary and the beneficiary's siblings. This is a lifetime limit per borrower. Parent loans can also be repaid by temporarily changing the beneficiary from the student to the parent. And those were just a few things. There's so much more we could talk about when it comes to college savings and 529 plans. So that's why we have a ton of articles that you can find at thecollegeinvestor.com to dive in a little bit deeper on these tips we talked about today and more about college savings. Thanks so much for stopping by today. Please get to know us on social media too. Follow us or like us or whatever on any of your social media platforms, whatever your favorite is. Just search for The College Investor and you'll find us. Thanks again, and we'll talk to you again real soon.